Hello, car enthusiasts. We're diving into some major developments in the charging industry that you won't want to miss. Now, picture this, a part of the charging company owned by Stellantis, Tesla's rival, and General Motors has just gone belly up. This could be a sign of things to come for many other charging companies. The interesting twist here is that Tesla is now in a position that some might call a monopoly in the US charging market. Stellantis and General Motors, well aware of this, instead of going head-to-head with Tesla, have chosen a different strategy. They've allowed this charging company to go bankrupt. It's crucial to note that Stellantis and General Motors will be incorporating Tesla's KNX chargers into their vehicles from 2025. It seems like a subtle admission that if you can't beat them, join them. Tesla's KN connector and supercharger network are gaining momentum, becoming the de facto standard for Stellantis and GM. It's almost like saying, if you can't compete, collaborate. Interestingly, the CEO of the now bankrupt charging company was a longtime executive of both General Motors and Ford. Now they've filed for bankruptcy. Coincidence or not, it's worth raising an eyebrow at. Mark Leaney, the former executive of Ford and GM, was at the helm of this company. Now, Stellantis, having adopted Tesla's North American charging standard, and General Motors, well, they've partnered with Charge Enterprises to install over 2,600 chargers at their dealerships across the U.S. Charge Enterprises had also been installing chargers for Ford. The company announced its plans for a so-called restructuring, which is just a fancy way of saying they've entered bankruptcy proceedings. Now, let's talk numbers. The company has surprisingly low liabilities of $48.7 million against assets worth $114 million. What's a bit peculiar here is that General Motors, a giant in the industry, invested in Nikola, a move that raised many eyebrows. There were countless YouTube videos shouting red flags about Nikola. Yet General Motors went ahead and divested from them anyway. It seems like Stellantis and General Motors might not have done their due diligence on this charging company. This New York-based company provided end-to-end project management services in the electric broadband and EV charging markets. Despite generating $132.5 million in revenue in the third quarter of the previous year, compared to $185 million in the same period of 2022, their revenue was on a significant decline. The blame game has started, with the company citing issues in negotiations with the primary investment consultant, Kenneth. According to Automotive News, the company claimed it was supposed to gain access to another $10 million held by co-acquisitions. However, when they needed that cash flow, it was unexpectedly and unjustifiably unavailable. In simpler terms, a company that was providing them with funding suddenly pulled the plug. They realized they couldn't pay it back, so they decided to cut their losses. This scenario may sound familiar if you think about companies like Nissan. It's a bit crazy, right? Just like Nissan, a well-known brand, had its debt rated as junk before going under. Keep in mind, folks, it's worth considering that the company found out the money had been transferred to other affiliated companies, or so the bankers say. Yes, we were about to lend you some funds. So we just left off with a company that decided, you know what? We've reevaluated our finances, and we're not willing to risk our entire investment. No more cash for you. The companies, in turn, took legal action against Co. and its former president. However, Co. argues that the case lacks merit, asserting that the companies had regular access to account statements, and the company had the authority to use the funds to cross-account guarantees. Now, I'm no financial expert, but it seems like a tangled web of financial jargon. In the grand scheme of things, this charging company is just one of several EV companies filing for Chapter 11. It's becoming a trend. EV companies, especially EV charging companies, are facing financial woes. Fisker is teetering on the edge of bankruptcy. Well, they claim they're going to rescue Fiza, which sounds ridiculously far-fetched to me. Then there's Lordstown Motors, the EV parts manufacturer Protier, and Last Mile Electric Solution, including NextEra Energy, all announcing layoffs. And over in China, there's been a wave of bankruptcies, with one of the largest luxury EV manufacturers letting go of its entire staff. That's basically bankruptcy, a way of admitting they can't continue. But wait, there's more. Jaguar, a renowned name in the industry, apparently sent an email to dealerships. The dealerships, in turn, sent emails to employees, revealing that Jaguar's plans are all a joke. they won't be producing combustion engine vehicles in their factory after a month of production in 2025. Yet, internal memos suggest that these EVs won't be rolling off the production line until 2026. Now, the plot thickens as Tata, Jaguar's Indian-based parent company, is reportedly considering listing Jaguar for sale. Who do you think will swoop in to buy them? My money's on a Chinese conglomerate, maybe J. Regardless, serious structural issues are at play here. Surviving in the charging market is proving to be a tough gig. And let's face it, being a rival to Tesla in the US charging scene is no walk in the park. They've got that game down pat. So, as we wrap things up, I want to express my gratitude for tuning in. Thanks for being a part. Until next time, take care and goodbye.